2,000%. That's how much one man's investment exploded in 18 months, right before it wiped out fortunes across an entire country in a matter of weeks. Meet John Law, Scottish gambler, convicted killer, self taught economic genius, the man an entire government trusted to rebuild its finances from nothing. And here's the part that makes this story insane. The very system that made him the most powerful banker in Europe was the exact same system, running the exact same math that was about to destroy the nation he was supposed to save. John Law wasn't a banker by training. He was a mathematician, a card player, and, according to historical records, a convicted killer who'd escaped a London prison. He'd spent years pitching European monarchies on a radical idea: replace gold with paper money, back it with land and trade, and you can eliminate debt overnight. France finally said yes. In 1716, Law opened the Banque Générale, issuing paper notes and extending credit at a scale France had never seen. The following year, he took control of a struggling trading company that would grow into the Compagnie des Indes, better known as the Mississippi Company, holding exclusive rights to develop France's Louisiana territory. On paper, it was brilliant. But here's what nobody in France saw coming. The same mechanism that made Law a genius was about to become the exact reason it all fell apart. The pitch Law sold to France was elegant. Louisiana was overflowing with gold, silver, and exotic trade goods. France owned the company, exploiting all of it. You could own a piece of France. By early 1719, shares were trading around 500 livres, close to a year's wages for a skilled Paris craftsman. 11 months later, they'd rocketed past 10,000, nearly 2,000%. The word millionaire didn't even exist before this. French coined it on the streets of Paris to describe the fortunes this bubble was minting overnight. Rue Quincampoix, the street where shares changed hands, ran transactions from 6 in the morning until midnight. Imagine a scene Charles Mackay described in his 1841 account: a hunchbacked man reportedly renting his back as a writing surface for traders too busy to find a desk. Whether literally true or embellished folklore, the image captures something real. The market had consumed daily life entirely. Every social class was in: nobility, clergy, craftsmen, household servants. The hunchbacked man wasn't the strangest part of this bubble. The strangest part is still coming. Here's the part that Law's own system made inevitable, and that he somehow failed to see coming. To keep share prices rising, Law's bank printed more paper money to fund new buyers. More buyers pushed prices higher, which attracted more buyers, which required more printed money. He was using freshly created currency to inflate an asset that justified the currency's existence. It was a perfect closed loop right until it wasn't. When the Prince of Conti, one of France's wealthiest nobles, demanded his paper holdings be converted to physical gold coins, 3 wagons of gold reportedly left the royal bank in a single day. Law's system had a foundational problem. There wasn't enough gold to back the paper. The loop had an exit door, and someone just found it. By May 1720, the French government attempted to officially devalue both the shares and the paper currency simultaneously. That announcement triggered a full panic. But here's what nobody expected. The crash wasn't the real disaster, it was the reveal. Shares that had peaked near 10,000 livres were down to 2,000 by September, and to 1,000 by December, a collapse of nearly 90% in under a year. Historians estimate the collapse wiped out fortunes across all economic classes. Law had printed so much paper currency that inflation had already been quietly destroying purchasing power for months before the crash. People who had converted shares to cash early were holding money that bought less each week. Those who stayed in lost almost everything. John Law fled France in December 1720, reportedly leaving with little more than his carriage. He died in Venice 9 years later, nearly broke. Here's what most retellings leave out. France wasn't alone. That same year, across the Channel, Britain was living through its own version of the same story. The South Sea Company had promised investors a fortune in trade with Spanish America. Trade that, like Louisiana's gold, barely existed. Its stock rose from around £100 to nearly 1,000 within months. Sir Isaac Newton, the man who'd mapped the laws of gravity, got in early, took his profit, and got out. Then he watched the price keep climbing without him. He got back in near the top. When the South Sea bubble collapsed that autumn, Newton lost a fortune and is said to have remarked that he could calculate the motion of the planets, but not the madness of people. 2 countries, 2 currencies. The same crowd psychology running at the same time on opposite sides of the same sea. Neither one learned from the other, because by the time each bubble was obvious, it was already too late to matter. What Law built wasn't a scam in the conventional sense. He genuinely believed in his system. That makes it more interesting and more dangerous. The mechanism that destroyed it is what behavioral economists now call a feedback loop. Rising prices created a narrative of guaranteed returns, and that narrative pulled in more buyers, who pushed prices higher still. Robert Shiller calls this a price to story to price cycle. Every new buyer was confirming the previous buyer's decision. Nobody wanted to be the person asking, but what's it actually worth? Because asking that question meant rejecting a story everyone around you had already accepted. The information that could have broken the spell, that Louisiana was largely undeveloped swampland, existed. It just wasn't convenient. 3 centuries later, the same feedback loop runs on a different operating system. Consider what happened with certain cryptocurrencies in 2017. Projects with no working product, no revenue, and no clear use case raised hundreds of millions of dollars in weeks. Because the price was rising, the rising price attracted coverage, the coverage attracted buyers, and the buyers confirmed the price. The narrative did the work that fundamentals couldn't. In 2021, a single Reddit thread about GameStop moved billions in institutional money. Not earnings, not product launches, a story. A few years after that, blank check companies raised money on nothing but the promise of a future deal. Sight unseen, and investors piled in anyway, chasing the same feeling. The price is moving, so something must be true. Law would have recognized all of it immediately. The crowd using price movement as a substitute for analysis, the conviction that someone else would always pay more. The technology changed. The psychology didn't move an inch. Here's the uncomfortable part. The people who lost everything in 1720 weren't stupid. They were responding rationally to social signals. Their neighbor was getting rich, the price was going up, the government had endorsed the whole thing. The question law's bubble forces on every investor is simple. Are you buying the asset or are you buying the crowd's confidence in the asset? Because those two things feel identical on the way up. They only separate on the way down, and by then the exit is the size of a keyhole with 10,000 people trying to fit through it at once. The crowd isn't a signal, the crowd is the risk. 300 years from now, someone might be telling your generation's version of this story. The only question is which side of it you'll be on. If you want to see what happens when the crowd does it again, with flowers instead of paper, that one's on the channel too. This video is for general educational and entertainment purposes only. It is not financial advice.